In terms of the percentage, I'm not sure that it's exactly half, but a fair number of E&P companies had their bank lines downgraded to a substandard rating, under the OCC guidelines. The reason for that in this go around was that they changed the guidance to include a total leverage ratio as part of the criteria that they look at. In the old days, substandard for oil and gas was really more of an advance rate issue, and how much was advanced against proven reserves, and what the payout of the facility was under various commodity prices. This time around, they had their old standards, but also added a total leverage standard, which, when you have a lot of bonds, high yield bonds behind your revolver in the capital structure, can lead to some issues. So there was a fair number of downgrades in the 2015-2016 timeframe. Today, though, a lot of that's been alleviated. Number one, by the reorganizations that happened, the bankruptcies, because that took away a lot of that unsecured debt that was there, de-levering the company. And also just performance is up, obviously, with commodity prices being higher. So I don't think that there are as many substandard companies out there today. Now, that being said, as these revolvers come to mature, the ability to replace them at the same size that they were at previously will be challenging. I think capital from banks is much harder to come by, as evidence that standards that make a conforming loan have changed and been tightened. So it is going to be a challenge to get all that bank debt refinanced in the bank market. And I think that's where private credit can actually play a role. The traditional sources of credit for upstream companies has been, the bank market and the revolving credit facilities, RBLs, and then the high yield market. And I think, we just talked a little bit about the challenges in the bank market. The standards there have tightened, which has restricted the amount of capital available. And in the high yield market, they're still willing to price risk that the banks can't price, but they won't price illiquidity. And what makes a liquid loan or bond is much bigger today than it was 10 years ago. For example, the average high yield deal in the market in 2002, I think, was around $230 million. Today, that's over $700 million. So it's a massive increase in size to access that market. So what fills the gap, right? And that's where private credit can come in, both for risk that the banks can't or won't price, and deals that would normally be priced by the high yield market but are just too small. And that's where we're seeing a lot of opportunity right now. Private capital is a massive pool. Think of it as institutional investors like endowments, pensions, family offices that want to basically tie their money up for a longer period of time and earn excess rates of return for doing that. And of course, there's the traditional private equity that everyone's familiar with. New things like private credit, which is what I do. That's sort of supplanting the banks in the high yield market. But there's also other alternative forms like drillco structures, which are basically just sort of private investors serving as a farm out participant in a field. There are companies that just buy royalties. There are companies that buy non-op working interests. And these are all just alternative forms of capital to help things move along. So there's a lot of different flavors out there and a lot of different participants willing to provide that capital. Well, from a credit perspective, there isn't much, to be honest. We can earn very attractive rates of return in North America, and obviously it's a much safer jurisdiction from a liens and perfection of the liens perspective. But for private equity, I think there is a great opportunity outside North America, particularly on a cost basis, right? Because you can get into plays much more inexpensively than you could in some of the core basins here. There's a lot of risk, obviously, in terms of proving these things up. There's a lot of jurisdictional issues in terms of access to minerals, access to markets, taxes and whatnot. So there's a lot of complexity to work through, but ultimately producing oil or gas at the cheapest possible embedded cost is what makes money, and I think there are good opportunities overseas. My company, Riverstone, has a business down in Argentina that's focused on that play. I think, it's, I don't know enough about it to give you a lot of detail, but I think that is the type of play that can be very interesting, because geologically it's very similar to things you see in North America, like in Canada and the Duvernay or in the Permian Basin, in terms of the quality of the rock, but the entry level is much lower in terms of what you can acquire acreage for and how you can develop it. The challenge is, of course, is there's no exports per se from Argentina, right? So it's mainly for local consumption. That economy, uses a certain amount of oil, and it's growing at a certain rate. So ultimately, whether that is something that has the benefit of, some price appreciation as well is unknown. But ultimately, that's the kind of thing I think you can look to internationally that would be interesting. The shift in mindset for investors around capital discipline has sort of, I think, lengthened the runway for many private businesses that maybe started up with a hope to put together a team and a drill-ready package, and then maybe flip it to someone with more resources to fully develop it out. I think the markets, both the private markets and the public markets, are demanding that those businesses be more cash generative before there's a massive premium put on them from an M&A perspective. And we see this in our business in private credit, that we can be a helpful solution in that regard, because a lot of times you'll be ready to drill and have a lot of asset value, but not necessarily have the cash flows or the proven reserves to get bank financing to help bridge that gap. And that's where firms like mine can come in and help do that, to extend that runway, get that growth and production level up to sort of a break-even point to where they are an attractive M&A candidate from either a private company or a public company. Some of these other alternative capital sources can be useful as well. Drill cos, selling off of working interest or things like that. But ultimately, those are probably more dilutive to the equity, the original equity, than, say, a credit line would be. So, but there are lots of alternatives, and I think you're absolutely right that that is a growing trend that people are going to have to adapt to over the next, 6 to 12 months.
To stay up to date on the most recent Hart Energy videos, subscribe to our YouTube channel by clicking here.